Personal Finance Practice Problem using OneNote. Personal Financial Statements, Part 1, Balance Sheet. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab down in the 2130 Personal Financial Statements Part 1 tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our practice problems will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. We're looking at the financial statements, the primary two being balance sheet and income statement, focusing this time on the balance sheet that we will be compiling from our data here on the left-hand side, remembering that the balance sheet represents where we stand at a point in time. We're going to do this more on a cash basis than an accrual basis, but we'll try to point out those differences between the two as they come up. Also note that when you compile financial statements, putting them together for your personal financials, you want to decide how you're going to be doing that. You might do it with more of a full kind of accounting, double entry accounting system, or you might be pulling together the data on a periodic fashion in some other fashion. You could use software no matter which fashion you might use. If you're going to do a double entry accounting, you might use something like a QuickBooks or a OneNote or a Wave accounting so that you can actually kind of take the data from, say, your bank account, for example, and record it transaction by transaction, which will compile both the balance sheet and the income statement for you, which is a little bit more difficult than if you do the other option, which is basically just to compile the ending balances from the data, either your financial statements or using software that can compile financial data from different accounts, basically taking the ending balance instead of the data, which is quite good to give you the financial data for the balance sheet, including bank accounts, savings accounts, investment accounts, mortgages, loans, credit cards, but not so good for compiling the income statement items, so you'd still have to kind of think about the income statement items. So we're going to think about how to take this data and then just kind of take our accounts and put them together to the balance sheet first. And we'll first just go through these list of accounts and try to name the accounts and color code them according to our color coding, where we have the assets being green, the liabilities being orange, and then we're going to say anything in equity or the income statement will be some shade or format of blue. As we go through, we might then talk a little bit too about where you might get some of this data that we're going to be looking through. Okay, so we're going to have the same list of accounts down here, but now I'm just going to go through them and color code them. So the first one is rent for the month. Obviously, the rent for the month would be kind of a fixed cost, something that you would know, and that's going to be what we would think of as a form of expense type of cost or a cash outflow. I'm going to make that light blue, any of the cash outflows that would be in essence on the income statement. The spending for food. Note that when we think about food, that might be one of those areas where you kind of break out a lot of subcategories possibly for the types of foods you eat. Possibly you have something for groceries versus restaurants or something like that. But no matter how you calculate them or how you put them together, they will be outflows typically. So we're going to be putting them on the income statement. Note that those expenses are often the ones that will deviate most greatly from something on the business side having a business objective. Therefore, the accounts kind of are more standardized. On the personal side, because we don't have that business objective per se, I mean, we still have kind of a business objective of revenue generation, but that's not our only or primary goal. So therefore, you might have different accounts for things like food and whatnot that have different objectives. Then we have the savings account balance. That would be a balance sheet account. We're talking about the balance, not the activity that happens in the savings account in this case. And you might get this from a software that compiles the ending balance, not like a QuickBooks, but financial software that takes the ending balance, say, from your bank, or of course from the bank statement or from your online banking. We've got the current value of the automobile. Now, this is going to be an asset. It's not a current asset, but it's going to be an asset. And note, this is one of those things that you might put on the balance sheet so you can track it, but realize that this is something that will not be updated automatically by, say, financial software, because there's no financial account it can update it from. And you're going to have to basically estimate it if you put this on the books, right? You're going to have to put the car on the books. We would imagine it's going to go down in value because that's what happens with cars. And then normally it would be an accrual type of thing to do that, meaning this is kind of a deviation from the cash basis to put this automobile on the books, because if you were on a cash basis, let's imagine that you paid cash for the automobile, then you would just simply write off the cash when you paid for the cash, and you wouldn't put it on the books as an asset because you would have expensed it when you bought the auto. But because the auto benefits multiple periods in the future, we typically deviate from a cash basis, put it on the books anyways as an asset here. And that means if it's on the books, you would normally have to depreciate it or write it down over time, which takes more time. That's an adjusting entry. So you got to deal with how you want to deal with the automobile. Do you even want it on the books? You might not need it unless it depends on what you're using your books for, because you might try to be tracking your cash flow kind of activities and whatnot. And if you put it on the books, then you got to realize that you need to depreciate it, decrease in the value over time, which takes a little bit more work, and that's an adjusting entry. You'll also have to determine what the depreciation is, what the book value is, which would take some kind of appraisal process. Then we got the credit card balance. So obviously you can get this from the credit card statement. You can also get it from oftentimes connecting to a bank, either in terms of the bank detail, connecting to something like QuickBooks so you could track it, or the ending balance from other software that can basically pull in the ending balance from financial institutions, it on the liability side. Auto insurance monthly. So if we pay auto insurance on a monthly basis, then you can kind of think of that as an expense. On a cash flow basis, we would think of it as an expense. Realize that if you pay monthly, it's not that big of a deal. But if you pay like auto insurance for the entire year in January, then you have an issue from a cash basis to an accrual basis, which may or may not be a problem for you, but one you want to note, that being that you're going to end up writing an entire year's worth of auto insurance off in January. When you compare January to February on the expense or performance statement on the income statement, the January will look worse than February, even though it's not really fair when you think about what you actually consumed, because you consumed the same amount of insurance in February as you did in January. It's just that you paid for a year's worth of insurance in January because probably it was cheaper overall to do so. So for that, you got to at least keep that in mind, or you can do an accrual kind of adjusting process if you want to kind of deviate from a cash basis to do that. Then we have the video equipment. So this is another thing that's a personal asset. It's not cash. It wouldn't be on your financial equipment, on your financial statements. So when you use software, it wouldn't automatically pull in if you're using financial kind of personal finance software. You'd have to appraise it somehow. If you didn't just buy it, you'd have to appraise it. It's also a deviation from cash when we put it on the books as an asset because we already paid for it. So we're saying if we're putting it on the books as an asset, then we're not writing it off at that point in time, which makes sense from an accrual standpoint because it's going to be benefiting us in the future. It's another thing where you may or may not want to put it on the books as an asset, kind of depending on what your objective is. Are you trying to track the cash flow, or do you need the equipment on there possibly for business purposes or something like that, so you can track the depreciation? If you put it on there, then you're going to have to devalue it or decrease the value over time. Usually that's done with the form of depreciation, which is an accrual kind of concept. Lunches, notice that this is another expense for our food. That's another category of food expense. If it were a business, it might simply be called like meals and entertainment. We're going to break it out a little bit differently here so we can track what our personal goals are. Personal computer. So if we have a personal computer, then once again, when we bought it, we might just write it off as an expense, although it's a fairly large one. On an accrual basis, you would put it on the books as an asset. It's not something that you could get from a financial statement or anything from your financial institutions. You'd have to put it on there manually and then depreciate it if you choose to put it on your books. That would be depreciation that would be an accrual kind of concept. Clothing purchase. So if we had a think that our category for clothes, this probably would not be a category for business normally, but for our personal use, if we want to break out how much we spend on clothes and track that, then of course that might be a good thing to do depending on what we're doing. Monthly take-home pay. When you think about the take-home pay, if you're a W-2 employee, then you're going to get your take-home pay, which is going to be after all the deductions, which include at least payroll taxes, Social Security, Medicare, federal income tax that was taken out before you got anything. So you could record, and then you might have benefits as well, which might be a 401k plan and health insurance, for example. Now, you might just say, hey, look, I'm just going to go ahead and write off those and just put the take-home pay in because that's what's actually going to hit my checking account, even though I really earned more than that and they took money out of it for me on my behalf for at least taxes and possibly benefits like a 401k and retirement plan. So that's a decision that you've got to make. Do you want to take the amount of the take-home pay, which you could find on your bank statement, and this would be an income statement revenue item, or do you want to look at your pay stub, which an employer is required to give you, which will give you the gross pay, and then record the expenses that you would have related to payroll taxes, and then possibly deal with the cash flow related to a 401k plan or insurance, noting that a 401k plan is a little bit more confusing as well from a bookkeeping standpoint, because although it's coming out of your pay, it's going towards an asset rather than being consumed as an expense. Then we have the checking account. So this is going to be your checking account would be, if you were using software like a QuickBooks, you would actually compile the ending balance of the checking account by recording the detail in the checking account using possibly the bank feeds. If you were using something like financial software, it would then just pull in the ending balance of your bank account periodically whenever you tell it basically to do so. And then we got the balance of an educational loan. This is one where this would be a liability. You owe a loan, balance sheet account. This is something that you could get possibly from the financial institutions. So if you were using software that was connecting to your financial institutions, pulling in the ending balance, it might pull in the ending balance periodically. And then we got the telephone bill monthly. This, of course, you could get from your bill, or if you were doing this and tracking it like your full service accounting system, when you pay the bill, you might track it in something like QuickBooks, and you would record the bill when you pay it, in essence, and then it'd be cash in the bill. Or if you're using other accounting software for these expenses, the income statement items, where it's just pulling in the ending balance from your financial institutions, you'd have to actually get the bills and compile them in some way. Then we have the loan payment monthly. This is something from a cash flow statement, which would be a decrease in the cash flow. It's something that you might get from the financial institutions if you're connected to them, either with a QuickBooks where you enter in the data, or you'd see it in QuickBooks when you pay the bill because it would come out of cash, or it would be, if you're using financial software that pulls in the ending balances, it might give you the ending balance of the loan, and you'd have to think about the payments that would happen because the actual payments wouldn't be on that side of the software. Also note it's a little confusing with the payments for the loans because normally it has an accrual component to it, meaning that you got to break out the loan payment generally from the interest, which is the rent on the loan, versus the principal, which is going to reduce the loan balance. So if you were to record this in a full service accounting system, you would have to break out the interest versus the principal so that you can track the loan balance properly. If you were doing this on like just using a cash flow kind of basis, then you could possibly think of the whole payment as a decrease from a cash flow basis that's going to basically come out of your checking account. We got the household possessions. This might be things like your couch, your TV, and whatnot. And these are other fixed type of assets, things that are similar to the car here, that once again, you're not going to be able to get for their assets, but you're not going to be able to get them from the financial institutions. You may or may not even want them on the books. They could help you to kind of get your true value on there, but they are kind of a deviation from the cash method, because when you paid cash for them, if you were on a cash method, you would have just expensed them at that point in time. Putting them on the books is an accrual type of thing to do. And then you, of course, have to decrease them in value because they're going to depreciate or go down in value over time, which are adjusting entries, which can take time to do. Payment of the electric bill. So when you do the monthly payments for an electric bill, when you make the payment, if you were using something like QuickBooks, you would see that, and it would actually record that when you kind of make the payment generally or enter the bill. If you were using other kind of software pulling in the ending balance from financial institutions, this is one that you would have to get when creating the income statement from, say, just simply the bills. monthly donations to charity. So if you were to give to charity, this is something that if you were to do that in QuickBooks or something like that, you could some kind of accounting software, you would track it when you actually pay it out of the cash when it comes out of your checking account. But if you're not using that kind of software, you're using financial planning software, then it's only going to give you that ending balance, and you're going to have to compile and track this data some other way to be able to compile it and track it. Then we got the value of the stock investments. So if you have investments in stocks and bonds, for example, that then would be a balance sheet or asset account, which if you were, you'd have to enter the detail if you're using something like an accounting software like QuickBooks. If you're using financial software, you can connect to that financial institution, and it will typically give you that ending balance data as well for that. And then finally, we've got the restaurant spending monthly. So this would be how much you spend on the restaurant, which would be another kind of expense category. Notice it's another kind of food category we're breaking out here. Okay, so now let's see if we could just construct this balance sheet. I'm going to do this fairly quickly because we've seen the balance sheet before, and then we'll move on to the income statement. So we've got the assets. I'm going to pull in all the green assets, noting I'm going to have the liquid assets with a colon and then an indentation, the most liquid assets first. Note also that the liquid assets, you might call them current assets. That's typically the name when you're going to be on a business type of setting. So either one would work. These are ones that are going to be able to spend quickly. So we got the checking account. We've got the savings account balance. And I put the value of the investments up here too, things like stocks and bonds. And I'm putting them up here because I'm assuming these are not under the umbrella of, say, an IRA. So if they're not under the umbrella of an IRA or a retirement plan, a 403B or a 401k, then they're fairly liquid because I can then get to the cash selling them fairly easily, although there is volatility in them both going up and down, and you could have some tax consequences of them. So you could decide to break out your financial investments separately, but I would still have a different category for my financial investments that are locked in to something like a retirement account, which I cannot get to without being pretty heavily penalized, and those that I can get to and therefore are fairly liquid. So that's going to give us our total, which we're breaking out in the outer column, 600 plus the 2,100 plus the 3,400, giving us a 6,100. Then we've got the non-liquid assets. So that's going to be the value of our current value of the automobile, the video equipment, and the personal computer. So these are three things. And if you compare this to, say, for-profit kind of business accounting, you might call this property, plant, and equipment, right? We got the non-liquid things here, which are kind of we're looking at basically tangible things here. Anything that comes and is connected to a financial institution, I might have another category for it because I might be able to draw that information if I'm using software from the financial institution, right? And anything that's not from a financial institution, I have to then put it on the books and then track it myself, meaning most of these items I'll have to depreciate over time in some way, shape, or form if I choose to put them on there, which is usually an adjusting process. These are those accrual kind of categories or accounts that you'll have to do, usually recorded depreciation related to them. Also note that another big one, if you have the home, would be a home, and that one's a little bit different because the home you would expect might go up in value. And so the home is usually one thing where you still, even though it's something that you have to appraise and you can't get it from the financial institution, you might want to still put it on there because it is such a significant financial asset to most people. It's the same concept in that it's deviating from kind of a cash method, but it's so significant to most people that it's worth putting on there, and it might be part of your retirement plan to have the home because you might be relying to some degree on the value of the home in some way, shape, or form as part of your retirement planning. So then we got the household possessions, which again, these are all things that are kind of tangible type of things, similar to property, plant, and equipment, except that property, plant, and equipment on the business side, remember, everything on the business side is there in order to help you generate revenue in the future if we're talking about assets. Here, of course, we have all these assets. We have them just for our personal use most of the time in order to live well. So that objective's a little bit different, which leads to some of the differences in terminology. Then we've got the total assets. So that's going to be adding up the total liquid assets and the total non-liquid assets. Then we have the liabilities. These are things that we owe to third parties. We got the current liabilities, those things that are due within a year, which we're going to put the credit card payments of the 310. Remember, that's something that you might still be able to get that even from a financial institution using software that pulls in the ending balances, like personal financial software, investment type of software, because you would get that from a financial institution even though it's a liability. That's our only thing, so I put it in the outer column here as the total current liabilities. Note that we could put this item on the right as well because it's the only thing in that category instead of having a redundant subtotal. But I like to have the redundant subtotal here just to show the form. Then we have the long-term liabilities, which is the balance of the educational loan. Note that that is something that might be long-term because it's going to extend over a year into the future, but you might have a current portion to it. And that's always kind of another accounting kind of issue that you got to basically say, okay, I'm going to put it in the long term so that I can compare my current liabilities to my liquid assets to see whether or not I can pay off the current liabilities. And this is clearly mostly long term, but it might have a short term portion to it, which I would either have to periodically put in there with an adjusting entry periodically. That's how it's done normally in normal accounting processes. If you're doing something like a QuickBooks and adjusting entries at the end of the year, you would do an adjusting entry monthly or yearly, pulling out the current portion into the current portion. Or you can just realize that that's going to be there. Or if you make this periodically, put this together, if you were to pull these balances in from financial institutions, the software would probably pull the balances in these two separate accounts. And then you'd have to go in here and say, okay, how much of this is actually due in the next year? And then do your analysis as to, do you have the current assets in order to pay that off? Then that's going to give us the long-term liabilities. Same issue in that this is the only account, so you could have put this directly in the outer column. We have another redundant subtotal just to copy the format of having the colons, then the indentation, then the double indentation, bringing it into the outer column. And then we've got the total liabilities. Notice it's only adding up one column at a time. So now we're just adding up the ones above it, the 310, the 3,100, total liabilities at the 3,410. Then we have our assets, the 21,950 minus the liabilities of the 3,410 gives us the 21,540, the net worth, or what would be called the equity side of things if it were a business, net worth here, which this is our accounting equation, which you can see as assets equal liabilities plus the net worth or equity, or you could see it as we calculated it here, assets minus liabilities equals the net worth. Now remember that if you were to do this calculation by using, say, the method, say possibly using a software where you're taking all this information from the financial institutions, all this stuff you would be able to get from the financial institution as of the ending balance typically. This would be not something like QuickBooks, but something like a personal finance or investment software. This stuff you couldn't pull in because this is stuff that's not connected to a financial institution. This is stuff you got basically lying around at your house or close to it. And this stuff basically is all stuff that you could also get from the financial institution. And then basically it's, in essence, subtracting these two out to get to the bottom line of the net worth. That's different than if you were to do the double entry accounting system using software like a QuickBooks or Wave accounting or OneNote. I'm not trying to promote one thing or the other, but anything that records a double entry accounting system would be taking the detail in, say, the checking account, which is where you spend most of your activity calculations, and it would be used to basically, construct some of these balances that would be taking place. It would be used to construct basically the income statement, the detail, and the income statement would be the thing that would drive the difference between, say, last month's net worth. Let's say last month you had 20,000 in the net worth, assets minus the liabilities, and this month you got the 21,540. The difference, the story of how you got from 20,000 to 21,540 is the income statement, which can be constructed quite easily, although it does take more work to do the accounting process, double entry accounting in software like a QuickBooks or something, than if you're pulling just the ending balances, in which case you'll have to compile the data for like an income statement in some other some other kind of way to kind of create that story between the two. So in other words, if you were doing a full service accounting system, this net worth could also be kind of verified by looking at the prior period's net worth plus the activity, basically the income statement, to get you to the current period's net worth.